Welcome to the Art of Money Podcast with Art McPherson.
And this is the Art of Money Podcast with Art McPherson and Luke McCarty, artofmoneyradio.com for more information on the McPherson Financial Group or to schedule that initial complimentary consultation. We appreciate you listening. Now, let's get to the show. A lot of people just now either paying off their taxes or maybe they're starting to get their refunds in the mails. But the big question is, did you get money or do you owe money? Many people believe that if you get a refund, you did it right. But if you pay, you did it wrong. So what's the case and how does the dynamic change with taxes once we reach retirement?
This is kind of funny because when you file your taxes, of course you want the refund, right? You want the money coming back to you. But what that means is you overpaid the government and you probably overpaid them every month or maybe every paycheck throughout the whole year. You know, when there was no interest rates, the last, call it 10 years, it wasn't as big of a deal. But now that you can make 4 to 5% on your cash, you literally just gave the government money to sit on. They're not paying you interest. So you could have either put that in the bank, put that in savings, even kept it in cash and made some money. So the rule of paying taxes of what you may owe versus not, and then paying a penalty or not, is you have to pay in 100% of last year's tax liability or 90% of this year's. So last year's is easy because you know what it is. So if you've at least paid in that, there's no tax penalty. Or you pay in 90% of this year's and there's no tax penalty. So in my mind, I'd rather have my cash sitting in an account making 4 or 5%, knowing that I'm going to owe something, but still avoiding the tax penalties.
I mean, it's nice, Mark, sometimes getting money back. But if you've just overpaid, $5,000 for the year, literally all that money has just been sitting in the government's coffers, and then they'll send you a refund at the end of the year. Unless that's what you do every year to have kind of a forced savings bucket. And I do see some people when they first come in with us, they're used to kind of doing that, using their taxes as a kind of a nice way to go on a vacation or a trip. But what we can do is instead, hey, let's take that $500 a month. Let's just put it aside in a savings account for you. And then right now they can make like 5%, like Luke was saying, just in a money market. And at the end of the year, instead of getting a check for $6,000, you get $6,000 that you just stuck aside in savings. Plus you get an extra $600-$700 of growth on it. So, it allows you actually on that kind of money, we're talking almost, even more. You're talking about really a couple grand. So, it could be pretty decent, or $600 or $700, whatever.
We always talk about having, streams of income in retirement. And obviously I'm not retired, but I host gigs on the side and I do charity events. And, I have like a talent fee that I'll charge people to, be a host or an MC. A lot of times when I get paid, they just pay me the bulk amount and they don't take the taxes out. And I got hit with a huge tax bill last year.
You probably loved that.
Oh my God. It was the worst one that me and my wife Gretchen, the worst tax bill we've ever had that we've owed the IRS. And it was frustrating and it was embarrassing. It's like, I should know better. Like I should be well educated enough to know that these supplemental incomes, I'm not getting taxed on them, but I'm going to have to pay it.
But if you're not used to getting that amount, it's hard to prepare for that. And then, you just have to kind of force stuff it. And that's why we have Mark Bernard here, who's a CPA, to help get our clients prepared for that. So when he's doing returns for them, he'll be like, hey, you've got a lot of 1099 income that you're not withholding on. We need to either increase your withholding from your W-2 income, or we need to account for that, because those kind of surprises are never fun.
Yeah, Mark does a good job, in the mid-year tax review. He will, theoretically, most of the time tell you as a client what your tax liability is going to be, whether you need to make quarterly payments, continue those, increase those, withhold more from a W-2, or sometimes withhold less from a W-2. So when Mark looks at all of our tax clients, you have a good picture of what you're going to owe, 6 to 8 months before you owe it.
321-425-8550. These are the conversations that you're going to have with Art McPherson and Luke McCarty and the team of the McPherson Financial Group, including the in-house CPA, Mark Bernard. 321-425-8550. That initial consultation, no cost, no obligation to you. And Art, Luke, for a long time, many retirees have subscribed to the 4% rule when deciding how much to take out each month to meet their spending needs. But there was a columnist in the Wall Street Journal that said, I use the $400 rule. You'll spend about $400 each month, in retirement above what you think you'll spend. What do you think of the $400 rule as opposed to the 4% rule?
Well, I haven't ever heard the $400 rule, but I think it depends how large your nest egg is in retirement. It could be $400, it could be $40, it could be $4,000. But I mean, I like it. You know, where they're coming from is basically you're going to spend more money in retirement than you are currently. Because currently you're saving, right? You're putting into the 401k. Maybe you're putting into a Roth IRA. You have all your expenses, your deductions, your health insurance, everything that comes out of your paycheck. But when you hit retirement, especially in the state of Florida, all you need to come out of that retirement account more often than not is going to be federal taxes. Now, if you do a lot of tax planning and get you tax free, you may not have anything coming out of those, and it could just be all yours. So, you know, the old rule was 4%. You know, this guy's talking $400 rule. But if it's me and I'm retired, I'm probably spending more than $400 a month just on eating. Because I'd be going out to lunch, maybe even breakfast. You know, and I don't really do that much right now.
Yeah, what Luke and I typically find, if you kind of group all of our clients together that are in retirement mode today, whether they're just starting retirement or they're going, you know, now in their mid 80s or even in their 90s, we have clients in their mid 90s now in retirement. Everybody tends to have their current budget today. So if you're working and you're used to making $5,000 a month take home, well, you're going to need that in retirement, plus probably another 20% for expenses. So if you're used to $5,000 in your budget now, that way you can save to spend. You put money in your savings account, put money set aside for those once a year bills and things like that, and then have that extra money. What that extra 20% is for is typically travel. So usually that first 10 years of retirement is going to be your most active. That's when you're out there doing those great trips and you're going to go see all the, you know, parks and all the great places you can RV or by plane, wherever you want to do it, however you want to do that, and just be able to have some of that travel money.
And Luke, you've said it before that, you know, it doesn't matter if you subscribe to the 4% rule, the $400 rule. Everybody's budget is different. You've said that you sat down with some people and they think they're only going to have this much per month, but you say, you've done a great job. You have a lot more. Go spend your money. Right.
We have those clients too who have been saving their whole lives, who I'm trying to, you know, convince to retire. When they finally do retire, they don't spend it. And we'll go a couple years down that path, right? Because it's your money, it's your path. You know, we just create the plan for you. But in a couple years down the road, it can be eye-opening of, okay, if you don't spend this money, who is and what are they going to spend it on? So we have those clients where some spend too much, some don't spend enough. You know, it's all in between.
Yeah, our great savers are typically the ones who have a tough time spending it because they're worried, I guess, that they'll run out or they won't have enough for something.
321-425-8550 to have these conversations. And earlier in the show, Luke, we asked the question, what is one of Art's favorite parts of being part of the McPherson Financial Group? And he said, the feeling I get when I tell people that you can retire, you've done a great job. Would your response be pretty much the exact same?
It would be very similar. And I've made a joke here that we need like a bell in the office to where when you make the decision to retire or you come in and you're finally retired, ring the bell, right? We'll get it on YouTube. We'll make fun with it. But that's a good eye-opening experience for a client, is us telling you can retire. And, you know, if I were in that situation, that's what I would want to know, right? If I can retire, tell me. If I can't, be honest and tell me what I need to do to get there.
You need a retirement air horn. So people across the office parking up, somebody else better retire. McPherson Financial Group done it again.
Yes.
I can see our staff now jumping through the roof the first month we're trying to work on that.
Or fireworks. Yeah, fireworks, but only one. It wasn't us.
Why is Art shooting Roman candles in the parking lot on a Tuesday afternoon in the middle of September?
Congratulations, another retiree.
Everybody's ready to retire. 321-425-8550. That's the first step, giving the team at the McPherson Financial Group a call. And let's begin that conversation. And you're also going to have a conversation about creating an income plan as well. Because if you have an income plan as part of your retirement picture, well, financial advisor Angela Sloan says, don't confuse that with what's going on in the stock market.
It's very important that you have your income plan in place. And there's things that you can do to get that income plan in place to where you're not depending on the market. The market is where you go for growth. It's not necessarily the greatest income plan in the world because because you never know what it's going to give you. And let's face it, no matter what happens, you're going to have to eat and pay your bills.
Yeah. So when we talk about creating that income plan, is this where a good conversation about annuities can come up?
Well, annuities can be a great tool, especially for income, because an annuity can have guarantees. So one of the things that's nice is if you need $5,000 a month for retirement income, and if you can make sure that all of that income is guaranteed through Social Security and like fixed payments to you, it really doesn't matter what the market's doing because it's not going to affect your income. That is the big deal about stable type investments and about things that have the guarantees. You want to make sure that paycheck is always there. And then you let the stock market and the growth of the market over time kind of be your hedge against inflation. So like last year when the market was doing really bad, but we had 9% inflation. It didn't look like it was working in that period, but now we're starting to get some bounce back this year and inflation's coming down. So over time, when you look at the historical averages, housing does very well over, 20, 30 years, and so does the stock market. So having money in those areas are always going to be beneficial over the long term for kind of keeping pace with as everything gets more expensive, your investments and your money will grow.
I agree with Art, and I also agree with what she said from a comment perspective, right? You need to have some of your money guaranteed, whether you're just relying on Social Security, whether you have an annuity, whether you have a pension, right? Those play a key role into your income plan, because in a bad market like last year, if all your money was in the stock market, it was probably hard for you to take money out because you're already losing money in the market, and then you want to take money out, so you're selling to create your income. This is where an annuity can come into play. It takes all the risk off the table and you get that check, you get that paycheck. Now, it's not going to be the whole boat. You can't have all of your money coming from one source, but it allows your growth money to grow and also have some volatility in the market. But this is where an annuity can come into play.
Art, we were having the conversation, Luke and I, last week about annuities, and there's some people out there that say that all annuities are bad, and that really feels like an oversimplification. So when you hear somebody saying, I don't touch them, I don't want to talk about them, I think they're all bad, how do you respond to that?
Well, if an annuity is always bad, why does every pension company in the world sell the pension to an annuity company?
Because they're not that bad?
Correct. Well, the insurance company, that's what they do. That is how they defer risk. They are good at that. They measure it. They've got actuaries that actually calculate. They can put a number to that risk component and actually what we call price it. So when you're buying an annuity or you're buying a life insurance policy, you're just averaging risk. So instead of taking the risk upon yourself, you're letting somebody else that has a lot bigger resources and dollars at their disposal to be able to share that risk with everybody else in America. So it's just a way to, rather than gamble on, okay, I'm just going to let the stock market go up and down every year. I'm going to take money out, and I don't know if I'm going to run out or not, but I'm just going to roll the dice that the historical averages over 25 years is going to work for me. You don't have to do that. You can build in some guaranteed layers in there where you can, if you need that income level, whether it's 5,000, 10,000, 20,000, you can say, all right, Art, Luke, I want 50% of that income guaranteed, or I want 30% of that income guaranteed, or I want 100% of that income guaranteed. And we can actually do that. So you can build in based on what your risk tolerance is, exactly the type of guarantees you want. And that's where annuities can be a big part of that story.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174. 725.
Today's show has been a work of art.